Hi friends, this is my fifth video in the lecture series on behavioral finance. In the field of investing, behavioral maturity is far more important than even your skill or your luck, because in the long run what happens is that your behavioral maturity stops you from making a lot of investing mistakes which immature investors do commit during their investing lifetime. So, another important behavioral bias which most of the investors suffer from is the concept called loss aversion. How many of you do like taking losses? Perhaps nobody likes the losses. In fact, an American behavioral economist, a very reputed psychologist, Dr. Daniel Kahneman, who won Nobel for his research in the field of behavioral economics, did a survey and he found that 1 rupee loss gives you same emotional it has same emotional impact. The loss of 1 rupee has same emotional impact as is gain of 2 rupees. That means 2 rupees or $2 gain is equivalent to $1 loss in emotional terms. It has the same emotional impact. It has the equal emotional impact based on his survey. That means when we gain, we obviously feel the joy. But then when we lose, even if we lose half than what we gained, it gives us, if not more, at least equivalent amount of emotional pain. So on one hand you have gain, on other hand you have pain. So the impact of this is that most of us always try to avoid the losses, and in the process of avoiding the losses we often end up investing in securities or investing in financial instruments or even non-financial instruments which produce suboptimal result in the long run. All of us do know that the fixed income returns are linear. The returns move in the straight line. So if you are fetching 7% return on your fixed deposit, it is 7%. Suppose the fixed deposit tenure is 3 years. Every year you are going to gain 7%. First year 7%, second year 7%, even in third year 7%. So you are getting 7% return on your capital employed or capital invested. What happens in case of equity markets or equity investing is that the returns are non-linear. That means the returns come in zigzag manner. In 1 year you may have say 20%, 30% positive return. Next year you can have 10%, 12% negative return also. So ultimately what happens is that since our mind is trained in such a way, our expectation from every investment is that we have to earn profit every year or all the time. But that does not happen, at least in case of equities. So since our expectation is unrealistic, the moment our equity portfolio starts showing negative return, we get puzzled. And as we get worried, often the brain starts saying that pull out your investment from equity market, move out of equity market, and we end up selling our investments, liquidating part of fully our portfolios in losses, despite knowing the fact or not knowing the fact that equities as an asset class outperform or have outperformed all other asset classes in the long run. So the comparison we make, suppose in 1 year you invested say 1 lakh rupees, next year the investment, after 12 months the investment value is reduced to 95,000 rupees. At the same time you invested 1 lakh rupees in fixed deposit, and after 1 year the value goes up to 1,07,000 rupees. Now you start comparing the equity return on equity, which is minus 5%, to return on fixed deposit, which is plus 7%. So immediately you realize that you have lost 5%. You get puzzled, and there is a great possibility that you will exit the investment, you will sell the investment at loss of 5,000 rupees. And after a year or after 2 years, you find that over, say, the FD is for a period of 3 years. So at the end of third year, compounded at 7%, 100 rupees becomes say 122 rupees or 123 rupees. That means 1 lakh rupees investment in fixed deposits shall become 1,23,000 rupees. Equity market, first year 1 lakh rupees, you lost, the investment value goes down to 95,000 rupees. Next year there could be 25% up move also. Third year there could be further up move, or it may go down slightly. But what happens is that 1 year, 2 year performance is not that important. In the long haul, if you compare the performance of fixed deposit to your equity funds performance, 5 years, 7 years, 10 years, you will find that the equities generally outperform fixed income securities in the long run. Likewise, if you say there is a big mistake which is committed by the investors of mutual fund schemes. Though you invest in one mutual fund scheme and it does not perform, at the end of the year you compare the performance of your scheme with some other scheme, may be of similar nature, may not be of similar nature, and you find that the other scheme has performed exceedingly well, and you switch your funds from scheme A to scheme B. Now as soon as you switch your funds from scheme A to scheme B, now scheme A starts performing and scheme B's performance goes down. Then again you commit mistake, you switch from scheme B to scheme C. Ultimately what you are doing is you are just switching your funds from scheme A to B to C to D, and ultimately you realize that your returns are suboptimal returns. So it is not that the investment product is bad. Investment product is good. But since your brain is not trained properly to be not trapped by loss aversion bias, you are committing mistakes, you are committing behavioral mistakes. And most of us, 90% of the investors, they do commit this kind of mistake, and ultimately that takes heavy toll on their investors' return. Investment return may be good, but the investor return is generally bad because of this kind of behavioral bias. I am citing another example. Suppose on one hand you have Nifty index. If you take Nifty's performance since its inception, it is around say 14-15% kind of return. Now in any period of 2 years, 3 years, 5 years, there is an actively managed equity fund which may have performed slightly better or slightly lesser than Nifty. But when you compare the performance of the same fund against Nifty over the last 20 years, you will find that there are several funds which have generated returns far in excess of the Nifty returns. So there are funds which have generated over even 20% kind of return if compounded over a period of 25 years, 30 years, as against the Nifty's 15-16% kind of return. So it shows that in the long run, if the investment is good and it is held properly, then there is a big possibility that it will be performing better than not only the equity indexes but against many other asset classes. Therefore, whenever taking any investment decision, just try not to be trapped by this loss aversion bias. Loss aversion is not good always. I am not saying that you should not be loss averse at all, but then loss aversion has to be judged taking into consideration all other factors. I hope that the concept of loss aversion is now clear to you. If you liked this video, kindly do subscribe to my channel and help me spread more knowledge about the financial markets by subscribing to my channel and sharing the link of the channel with other friends. Thanks a lot, friends.